Welcome. Today, we're diving into the world of initial public offerings, or IPOs. An IPO marks a major milestone for any company, as it transitions from being privately held to offering shares to the public. This process not only raises capital for the business, but also brings in new investors and increases transparency. In this video, we'll break down the key regulations, eligibility criteria, and the step-by-step process companies must follow to go public in India. Whether you're an aspiring investor or just curious about how companies get listed, this guide will give you a clear understanding of IPO essentials. For a business to raise equity capital from the public, it must be structured as a limited company. This means the company needs to register with the Ministry of Corporate Affairs and comply with the Indian Companies Act. Only limited companies can issue shares to the public, ensuring that investors have legal protection and the company follows standardized rules. This structure is essential for transparency and accountability, which are crucial when inviting public investment. Without this, a business cannot approach the securities market for equity funding. Banks, financial institutions, and non-banking finance companies, NBFCs, that want to raise money from the public through deposits must be approved by the Reserve Bank of India, RBI. They also need permission to borrow in the securities markets. This regulatory oversight ensures that these institutions operate safely and protect the interests of depositors and investors. The RBI's approval process is designed to maintain stability in the financial system and prevent misuse of public funds. Entities such as companies, governments, municipalities, and other organizations can issue bonds, debentures, or similar instruments to raise funds. However, they must comply with the specific regulations that govern their sector. These rules ensure that issuers are transparent about their financial health and obligations, giving investors confidence in the instruments they purchase. Regulatory compliance is key to maintaining trust in the securities market. Mutual funds play a significant role in the securities market. To raise capital from the public, mutual funds must be registered with the Securities and Exchange Board of India, SEBI. This registration ensures that mutual funds operate under strict guidelines, protecting investors and maintaining market integrity. SEBI's oversight helps prevent fraud and mismanagement, making mutual funds a safer investment option for the public. All securities issued to the public must be structured according to legal definitions. These include securities as defined under the Securities Contracts Regulation Act, SCA, deposits under the Banking Regulation Act, or as per the company's acceptance of deposits rules. This legal framework ensures that all instruments offered to the public are standardized and regulated, providing clarity and protection for investors. Make an initial public offer, IPO. A company must meet specific eligibility criteria. These include having net tangible assets of at least Rs. 3 crores for the past 3 years, an average operating profit of at least Rs. 15 crores over the same period, and a net worth of at least Rs. 1 crore each year. If the company has changed its name recently, at least half of its revenue must come from the new business activity. These requirements ensure that only financially stable and credible companies can access public funds. If a company does not meet the standard eligibility criteria, it can still make an IPO through the book-building process. In this case, at least 75% of the net offer must be allotted to qualified institutional buyers, QIBs. If the company fails to meet this allotment, it must refund the full subscription money to applicants. This route ensures that only serious and credible companies can proceed, even if they lack a long financial track record. Companies that have issued superior voting rights, SR, equity shares to promoters or founders, can only offer ordinary shares in their IPOs for listing on the main board. SR shares give promoters more voting power, but SEBI regulations ensure that only ordinary shares are listed for public trading. This maintains fairness and transparency for new investors entering the market. SEBI regulations require promoters to contribute at least 20% of the post-issue capital in an IPO. If their holding falls short, certain institutional investors or members of the promoter group can make up the difference, up to 10% of the post-issue capital. This rule ensures that promoters have a significant stake in the company's future, aligning their interests with those of new investors. If there's no identifiable promoter, this requirement does not apply. Promoters' contributions are subject to a lock-in period to ensure their continued commitment. The minimum lock-in is 18 months from the date of allotment in the IPO. If most of the issue proceeds are used for capital expenditure, the lock-in extends to 3 years. Any promoter holding above the minimum is locked in for 6 months, or 1 year if the funds are mainly for capital expenditure. These rules prevent promoters from exiting too soon after the IPO. The company must offer a minimum percentage of its shares to the public, depending on its post-issue capital. For capital up to Rs. 1,600 crore, at least 25% must be offered. For capital between Rs. 1,600 crore and Rs. 4,000 crore, the offer must equal Rs. 400 crore. For capital above Rs. 4,000 crore and up to Rs. 1 lakh crore, at least 10% must be offered. Companies must increase public shareholding to 25% within 3 years, if initially lower. If a company has issued equity shares with superior voting rights to its promoters or founders, it must list these shares on the same recognized stock exchange as its ordinary shares. This ensures transparency and equal access for all investors, preventing any hidden advantages for promoters after the IPO. Public issue of shares must remain open for a minimum of 3 working days and a maximum of 10 working days. If there's a revision in the price band, the bidding period must be extended by at least 3 working days within the overall limit. In case of unforeseen events like a banking strike, the period can be extended by at least 1 working day. These rules ensure that investors have enough time to participate and respond to changes. SEBI regulations require that at least 90% of the net offer to the public must be subscribed. If this minimum is not met, the company must refund all subscription money within 4 days of issue closure. To safeguard against undersubscription, companies often enter into underwriting agreements with institutions. Underwriters commit to buying any unsubscribed shares for which they receive a commission. Underwriting is mandatory for book-built issues, but optional for fixed-price issues. For making a public issue, companies must enter into agreements with depositories to dematerialize their shares. Dematerialization means converting physical share certificates into electronic form, making trading and transfer of shares easier and more secure. This step is crucial for modern securities markets, ensuring efficiency and reducing risks associated with physical certificates. Companies making a public offer may choose to have their IPO graded by one or more SEBI-registered credit rating agencies. The grading reflects the company's fundamentals, industry prospects, and business risks. Grades range from 1 poor fundamentals to 5 strong fundamentals. Importantly, the grade is not a recommendation to invest or comment on the issue price. If multiple grades are received, all must be published. Public issues of equity shares can be categorized as initial public offers, IPOs, and further public offers, FPOs. An IPO is the first time a company offers shares to the public, while an FPO is a subsequent offer by a company that is already listed. Both types help companies raise capital, but the eligibility and process may differ based on the company's history and financials. IPO is the first public offer of shares by a company. It can take the form of a fresh issue, where new shares are created and sold to the public, or an offer for sale, OFS, where existing shareholders sell their shares. The IPO changes the company's shareholding pattern, bringing in new investors and often increasing public scrutiny and transparency. A fresh issue, the company issues new shares, increasing its share capital and raising funds for business needs. In an offer for sale, existing shareholders, such as promoters or financial institutions, sell their shares to the public. The company's capital does not change, but the ownership structure does. Sometimes, an IPO can be a combination of both methods. Let's look at an example. Suppose a company has 1,000 shares, equally held by 2 promoters. If the company makes a fresh issue of 500 shares, the total capital increases to 1,500 shares and the promoter's percentage holding drops. If instead, each promoter sells 250 shares in an OFS, the capital remains at 1,000 shares, but the promoter's holding drops to 25% each, with the public holding the rest. Money raised in a fresh issue goes to the company, while in an OFS, it goes to the selling shareholders. Common example of an offer for sale is government disinvestment in public sector undertakings, PSUs. Here, the government sells a portion of its shares to the public through an IPO. The proceeds go to the government, not the company, and the public becomes part of the shareholder base. This process helps the government raise funds and broadens the ownership of PSUs. Further public offer, FPO, is when a listed company issues additional shares to the public. FPOs are used to raise more capital for growth, repay debt, or meet regulatory requirements for public shareholding. The company must meet certain conditions, such as not changing its name recently or earning most revenue from its new activity if the name has changed. FPOs help companies expand and strengthen their financial position. Make an FPO, a company must not have changed its name in the past year, unless at least 50% of its revenue comes from the new activity. If it doesn't meet this, the FPO must be through book building, with at least 75% of the offer allotted to QIBs. This ensures that only credible companies can raise additional capital from the public, maintaining investor confidence. SEBI allows issuers to decide the price at which shares are allotted in a public issue. The price can be fixed in consultation with the lead manager or determined through a bidding process. The 2 main methods are fixed price issue and book-built issue. Each method has its own process for setting the price and allocating shares to investors. In a fixed price issue, the company and its lead manager decide the price at which shares will be issued. This price is disclosed to investors before the issue opens, allowing them to make informed decisions. The company justifies the price based on its expected performance and prospects. Fixed price issues are straightforward, but may not always reflect true market demand. Book building process helps discover the price the market is willing to pay. The company sets a floor price or price band, and investors bid within this range. The final price, called the cutoff price, is determined based on demand. Allotments are made to those who bid at or above the cutoff. This method is more dynamic and often results in better price discovery for both the company and investors. Imagine a company wants to issue 5,000 shares with a price band of Rs. 120 to Rs. 144. Investors place bids at different prices. If the total demand reaches 5,000 shares at Rs. 135, that becomes the cutoff price. All investors who bid at Rs. 135 or higher get shares. Sometimes, retail investors may get a discount on the cutoff price, but it cannot exceed 10%. This process ensures fair allocation based on demand. Book-built issues, allocation is based on investor categories. If the company meets eligibility criteria, at least 35% goes to retail investors, 15% to non-institutional investors, and up to 50% to QIBs, with 5% reserved for mutual funds. If the company doesn't meet the criteria, at least 75% must go to QIBs, with lower limits for retail and non-institutional investors. This ensures a balanced and fair distribution of shares. The process of making a public issue involves several internal and external steps. Internally, the company must get board and shareholder approval. Externally, it appoints a lead manager who coordinates with registrars, bankers, brokers, and underwriters. The company seeks in-principle approval from the stock exchange, may get the IPO graded, and enters agreements with depositories. The draft prospectus is filed with SEBI, and after any required changes, the final prospectus is filed with the registrar of companies. This thorough process ensures regulatory compliance and investor protection.